Now we'll get started on the adult course. We are going to learn the role of the central bank, which in the case of America is the Fed.
Hi everybody, the role of the central bank is much more diverse than you might think. We spent a lot of time throughout the macroeconomics course looking at the role of the central bank to implement monetary policy, to influence the money supply, to set interest rates in order to meet an inflation target, and to make sure other macro objectives like growth and unemployment are being looked after as well. We've also looked about how monetary policy can involve changes in the exchange rate, which the central bank can do too. So to implement monetary policy to meet an inflation target, we spend so much time looking at that, we understand that. There is another role here, which is the central bank, like the Bank of England, acting as a banker to the government. We've learned that in order to set interest rates, the central bank will need to alter the money supply. And one tool available to the central bank is open market operations, engaging in the buying and selling of government bonds. Now in the UK, that's not a big deal. In the US, that's a much bigger deal. That's how the Federal Reserve over there will set interest rates. In that sense, the central bank can buy and sell government bonds on behalf of the government. In that sense, acting as a banker to the government. The central bank can also look at funky ways to reduce the interest rate paid by the government on government bonds. So in that sense, acting as a banker to the government, buying and selling of government bonds and reducing interest rate paid on government bonds. But there are also two crucial roles that the Bank of England will have in particular, the financial stability roles of the Bank of England, which have become a much greater responsibility of the central bank given the 2008 financial crisis. So after that, these two have become massive, massive deals for the Bank of England. First of all, to act as a banker to the banks, to act as a lender of last resort to the banks. This is all about preventing a bank run, to get involved, if need be, when there is a liquidity crisis for a commercial bank. Now we know all about liquidity crisis when the short-term liquid assets that a commercial bank has is not enough to meet the short-term liabilities that a commercial bank has. We know that that can create panic, there is a liquidity crisis, the end result could well be a bank run here. There is a role for the Bank of England to step in and to intervene. It's called the Liquidity Assurance Scheme. And there are two kind of branches of this scheme, where the central bank, the Bank of England, can offer non-emergency liquidity for commercial banks that just need, periodic liquidity, maybe, monthly or something, so not short-term, high-intensity, large-scale liquidity right now, but just periodic liquidity just to keep them through for the next few months. So that's non-emergency liquidity. You've also got the emergency liquidity branch here, where you've got a commercial bank that's in dire concern. They need large-scale liquidity. They need it right now. That's emergency liquidity. The central bank can also offer that kind of liquidity assurance. That's the lender of last resort function. And the central bank will do it if they feel like systemic risk is a big concern. The whole meltdown of the financial system is a risk here. In which case they'll say, look, we don't want to let this bank fail. We don't want liquidity to be an issue. We're going to step in and intervene. What central banks won't do often is intervene if a bank goes insolvent. That's when a bank makes bad decisions. They issue too many risky loans. They go bad. There's not enough capital to offset the loss in loan value, and they go insolvent as a result. The bank will simply say, well, too bad. You made bad decisions. You're just going to go bankrupt. You need to know that the Bank of England has got a fail-safe way of letting banks fail. So even if they don't want to intervene when it comes to offering liquidity, because that commercial bank doesn't meet the requirements, it hasn't met the conditions to get that liquidity, or if the bank goes insolvent, the Bank of England have got ways in which a commercial bank can fail safely, whereby the savings of individuals can be protected, where individuals can maybe divert their funds to other banks in an interim period. So it's not always the case of, well, we're going to bail you out. Insolvent banks often won't be bailed out, and even banks who are in a liquidity crisis may not be bailed out. But if the central bank feels that they want to, there is a need to, there is good rationale to, there are two branches in this liquidity assurance scheme, whereby commercial banks can access liquidity through the Bank of England. The other role the Bank of England has is to regulate. The other role the Bank of England has is to regulate the financial system. Again, powers which are now much greater since the 2008 financial crisis. So these two are financial stability roles that you must be aware of, significant roles. And these are very important to maintain confidence in the financial system, to prevent panic and a run on the bank, as we've just said, to make sure that the risk of financial instability is lower, to make sure that systemic risk is lower and the chance of financial system collapse is much lower. And also, if need be, if there is a rationale for a bank bailout, so even for an insolvent bank, the Bank of England says, look, we don't want to bail you out, but actually it might be in the best interest of the financial system and the interest of society as a whole for this bank to be bailed out, then they can advise the government on bank bailouts to prevent wide-scale financial collapse, which can cause deep financial crisis and deep recession. So it's important that that role is there to make sure that all these things are looked after and to make sure that bank failure and systemic risk isn't that much of a concern. Let's now evaluate the lender of last resort function of the Bank of England. From this video onwards in my playlist, I'm going to focus on these two roles in lots and lots of detail. So if you want to evaluate the role of regulating the financial system, watch my video on that, which is towards the end of this playlist, to get a really detailed understanding of one, how they regulate the financial system, what can go wrong with that kind of regulation. But I'm just going to focus now on evaluating the lender of last resort function of a central bank. I want to clarify at this stage, when I talk about liquidity, it's not just free money that the commercial bank can get. If it's non-emergency liquidity, there'll be interest payback on that, there'll be conditions or regulations imposed on the commercial bank afterwards. If it's emergency liquidity they need, it'll be even higher interest that the commercial bank will have to pay this money back to the Bank of England, and there'll be even stricter conditions, even stricter regulations in the future to prevent this happening again. We're going to evaluate that right now. Well, one major issue of this function is that the Bank of England might be promoting moral hazard. Moral hazard occurs when a risk is taken, a decision is taken, where if that decision goes bad, the cost is borne by a third party. So the third party in this case is the Bank of England, right, having to provide this emergency liquidity. You just encourage more of that behaviour, because a commercial bank knows that if ever they don't have liquidity, they can always run to the central bank and gain liquidity there. Linked to that is the idea that banks may simply just never hold sufficient liquidity, knowing that they've always got the central bank to hold their hand and to provide liquidity, whether non-emergency or emergency liquidity, if ever they need it, right? So a bank may decide that actually let's take greater risk, let's try and make more profit and not hold as many short-term liquid assets. Let's actually lend out longer term, because that's more profitable for us. And if ever our depositors come back and they need money, if ever we need to fulfill our short-term liabilities, well, we'll just run to the central bank if we need to. If we need to pay a bit of interest on that, even more interest on that, do you know what, let's do it, because the profit we can make is so much greater. You encourage that kind of activity when you've always got someone there on the side that's going to hold your hand, that's going to be there to protect you. Dangerous kind of incentives you're promoting with this function as a lender of last resort. The risk of regulatory capture. Absolutely. Regulatory capture, remember, is when the regulators might be influenced because they've got buddies who still work in the industry. The best regulators we know are those who have actually worked in the industry before. Chances are they've still got really good contacts with people who still work in the industry. Regulatory capture is when those who still work in the industry, so maybe managers of a central bank, actually get in contact with regulators who work for the Bank of England and say, look, you're providing us emergency liquidity, but, just lower that interest rate a little bit for us, because you're a buddy of mine, you can do that for me, right? Or they say, look, I know you're going to impose strict conditions and regulations, but maybe because I know you really well, just make them a bit lax for us, make them a bit easier for us. That's regulatory capture, and there is a risk of that, okay, if there is this, if there are these strong relationships between regulators and inside workers in the financial industry. And also, this is a good point to evaluate, right? Why should banks have this luxury of getting emergency liquidity, of essentially being helped out in times of crisis, when other firms in the industry don't have this luxury? If they go into trouble, well, off you go, you're bankrupt, goodbye, do something else. Whereas banks, they might have a way of continuing with this emergency liquidity that the central bank offers. Why is that fair? Why should they get this and not other firms? Well, you might say, it's individual savers that have their money in the commercial bank. Well, if the Bank of England say that there is a fail-safe way of letting a bank fail, then why not just let the bank fail? And also in the UK, £75,000 of individual savings are backed by the government for each account that an individual saver has. So therefore, actually, savings are not necessarily at risk. Why not just let the bank fail? Why are they so special? Especially if the Bank of England go whoop-de-doo and they go all blasé and all boastful about how they're so clever they can let a bank fail. Then why? Why is there so much intervention? Why is there so much emergency and non-emergency liquidity? Even the idea of a bailout, why should that be allowed to take place, when other firms don't have the same luxury. Nice evaluation point to consider. That covers this, guys. Very important role of the central bank, very diverse, lots to take in. I'll see you all in the next video.
Building your online business? Go to Wix.com and set...
So now we're going to actually start getting into more of that financial stability role and where it can go wrong. Now, when we talk about financial market failure, we're talking about the entire market. We're not just talking about one bank. So let's get right into this.
Hi everybody. Financial market failure occurs when freely functioning financial markets fail to allocate financial products at the socially optimum level of output. The end result is a misallocation of resources in financial markets. The next video looks at 4 specific types of financial market failure, but it's worth in this introductory video grouping up generically the reasons behind financial market failure. And then once you watch the next video, you can apply those very specific causes to these section areas. The first section area occurs when there is excessive risk being taken. And because there is excessive risk, there is a greater chance of bank failure and then systemic risk, i.e. Financial collapse and the whole financial system coming down. So if excessive risk is being taken, assets are being created and then bought and sold which are ridiculously risky, there is a greater chance of those assets going bad. And then it's not just the individual firm that goes bust, it can lead to an overall collapse of the financial system. So basically there is an overproduction and an overconsumption of these excessively risky financial assets. The key word is excessive risk. The consequences of this is that systemic risk is so much more likely. Now remember what systemic risk is. This is when there is bank failure, which is more likely to happen if there is excessive risk being taken here. But one bank failing can lead to many other banks failing, which can then bring down the entire financial system. I've covered that in lots of detail in previous videos. But the end result is that if the financial system goes to pot, there is a loss of confidence in the banking industry, in the financial industry. There is a loss of faith in banks. All bad news when banks are the backbone of the economy. Banks and the financial industry is why the UK economy is so big and so great. It's why we are the 5th largest economy in the world. We're very, very rich because we have a very strong financial industry at the backbone of our economy. Imagine if the faith and trust in banks is totally gone and confidence in the industry is completely gone. The impact it's going to have on the economy is significant, right? So systemic risk is a nightmare. And that becomes greater if excessive risk is being taken with the production of financial products and financial assets. If the financial system goes bad, if there is a complete collapse, we get financial crisis, we get deep recession like we saw in 2008, 2009. And the end result of that is not just lost incomes, lost jobs and lost output in the financial industry, but it's lost incomes, lost jobs and lost output throughout the entire economy. Deep recession, horrible consequences. We also might see bank bailouts like we saw post the deep financial crisis of 2008. And bank bailouts impact on the taxpayer. There is a negative externality there where the taxpayer has to bear the cost of these bailouts. And we are still suffering, the taxpayer, from bailing out all of these banks from the 2008 financial crisis. So the end result of excessive risk and then an overall collapse of the financial industry is very, very, very significant on society. The other group that we need to consider here for financial market failure is when there's collusive activity. So maybe financial market agents get together, or maybe banks get together and they collude to fix interest rates or to fix exchange rates in whichever way benefits them. Basically, we see monopoly pricing and we see a loss of welfare in these financial markets, which is a market failure in itself. Not good news here, where these agents and these firms get together simply to maximize their profits against the interests of society. What's also really interesting to know, guys, is that some say that deregulation of financial markets in the 1980s, 1970s and 1960s in both the UK and the US actually exacerbated financial market failure. It increased systemic risk. This deregulation was known as the Big Bang. It really made financial markets take off and the financial industry in both the UK and the US explode into massive proportion, where now it is the backbone of both the UK and the US economy. Huge, huge industries now. And it happened because this deregulation happened because Thatcher and prime ministers before in the UK, for example, wanted the economy to move away from manufacturing and mining towards financial services, towards the financial industry, allowing the UK to become much bigger. But some say it increased financial market failure, exacerbating it crazily, and increased systemic risk. Why? What kind of deregulations occurred? Well, look at how significant some of these were. Taking away, for example, capital and liquidity ratios. Now, that doesn't mean totally taken away. It means central regulation was taken away. So governments, for example, setting those ratios was taken away. And this was left now to the commercial bank, for example, to set capital ratios, to set liquidity ratios for themselves. Also scrapping reserve requirements, right? That again was centrally controlled in the UK in the 1960s, taken away with deregulation in that period of time. Very, very significant because it meant that the chance of bank failure is so much greater. What also happened, well, this major deregulation took place where commercial banking and investment banking no longer had to be legally separate entities. With deregulation in the 1980s, commercial banks and investment banks could work under one branch. So for example, Barclays have got a commercial banking side, a retail banking side, and also an investment banking side. Separate parts of their business, but still under the Barclays brand. That's allowed to take place with this deregulation now, for example. And that's dangerous because it means that commercial banking funds, safe profits that are made on the commercial banking side, could be used for investment banking activities, which are much more speculative, much more risky, much more likely to fail. The reason why they want to do it is because you've got safe funds here, which you're always going to have, to maybe make loads more money out of gambling in the investment banking side, for example. The danger is, though, that investment banking activity is so much more risky. The chance for those activities to go bad is much greater. And then it's not just the investment banking side of the business that will go down. It's the commercial banking side of the business that can go down too. So the risk of general bank failure is so much higher with these deregulations. What also happened with deregulation is that excessive bureaucracy and paperwork and red tape was taken away. And that's all well and good. That just improves the efficiency and the competition of financial markets. But these three deregulations improved, some say, the risk of financial market activity and increased the likelihood of bank failure and then systemic risk of the entire financial system going down. So interesting to know where potentially the increased chance of market failure came from. Some say this was the case, some say no, actually it wasn't this, but worth taking this away. Maybe this is the root cause of why there is such a greater chance of financial market failure and systemic risk like we saw in 2008. Stay tuned for the next video where we look at 4 specific types of financial market failure. I'll see you then. Thank you very much for watching, guys.
How to open your car door while submerged underwater. A fatal